I mean, think back to the spring of 2020. The global economy, it basically just effectively shut down.
Right. Completely
And
froze.
then millions of individual businesses were forced to close their doors. You had global supply chains freezing literally overnight, and corporate revenues absolutely plummeted. By every logical measure of, business performance, the market should have been in this extended freefall.
It should have been a total collapse.
Exactly. Yet, heading into the second half of 2020 and throughout 2021, the global stock market mysteriously defied gravity. I mean, it hit absolute record highs. So how is that mathematically possible? How can the reality of the businesses be so catastrophically bad while the reality of the market is simultaneously so good?
Well, it's the ultimate paradox of modern finance, honestly, and it perfectly illustrates the exact tension we are unpacking today.
Yeah.
Because you cannot solve that paradox by just looking at individual companies. You actually have to change your entire framework.
And that is exactly what we are giving you today. So, welcome to our deep dive. Today, we are taking you right to the heart of the most fundamental divide in the financial world. We are pulling our insights from an incredibly dense, but totally illuminating foundational text titled The Interplay of Microeconomics and Macroeconomics.
It's a great piece. Really lays it all out.
It really does. And our mission for you today is to give you a shortcut, really, to being highly economically informed. We are essentially handing you the ultimate toolkit to decode the financial news, understand what actually drives your stock portfolio, and navigate your own financial decisions without feeling completely overwhelmed by all that Wall Street jargon.
Yeah, because once you grasp this interplay, you stop just passively consuming financial headlines. You start seeing the underlying machinery at work. You actually learn how to diagnose why a market is moving.
Okay, let's unpack this. We have this fundamental divide, right?
Yeah.
Microeconomics versus macroeconomics. We hear these terms all the time. But let's ditch the textbook definitions for a second. I like to think of it this way. Microeconomics is like examining the biology of a single tree. You're looking at the roots, the bark, how it photosynthesizes. Macroeconomics is zooming all the way out and studying the entire forest's ecosystem.
That's a classic way to look at it, yeah.
But, and here is my pushback right out of the gate, if they are studying the exact same forest, why do they seem to operate by completely different rules?
Well, it's because they measure entirely different levels of decision-making. That is the critical friction point right there.
Okay, how so?
So the reason the rules seem completely different is that, a single tree or an individual business is operating based on self-interest and survival.
Right.
But the forest ecosystem, the macro level, is governed by broader systemic trends like climate and rainfall. But the thing is, they are deeply interconnected.
Right, because the forest is just made of trees.
Exactly. The individual choices ultimately shape the broader economy. The aggregate of millions of individual business decisions creates the economic climate that the government then has to manage.
I see. So, because understanding the forest requires understanding the trees first, let's shift our lens to that bottom-up approach. Let's dissect microeconomics.
Yeah, let's do it. What you really have to understand about the microeconomic bottom-up approach is that it is fundamentally descriptive. It's not prescriptive.
Meaning it doesn't tell you what to do.
Right. It doesn't dictate what should happen in a market. Instead, it just explains what does happen when conditions change. It focuses on human choices, resource allocation, taxes, regulations, all of that.
Okay, so it's observing the reality on the ground.
Yeah, and specifically how companies maximize their production to lower prices and compete. The text actually breaks down 4 specific principles that act as the pillars here.
Oh, right. Supply and demand being the big one.
Yeah, supply, demand, and equilibrium. That's the first one. That's how we create perfectly competitive markets.
Right, where buyers and sellers find that perfect price.
Exactly. Then there's production theory, which is literally just how goods are made, the most efficient way to build the thing. Third is the costs of production, meaning pricing your product based on what the resources cost you. And finally, labor economics, which looks at wages, employment, and income patterns.
Okay, wait, I have to jump in here because there's a detail from the text that genuinely gave me pause, and I want to challenge this a bit.
Sure.
The text states that the rules governing microeconomics flow from a set of compatible laws and theorems rather than beginning with empirical study.
Yes.
Wait, so microeconomics is almost more like pure math or philosophy than an actual observational science. I mean, how does a regular person even use that? It sounds completely abstract.
I know, it does sound incredibly academic when phrased that way, like
Yeah.
just a bunch of professors doing calculus in a vacuum.
Exactly.
But for you, the listener, this actually translates into something incredibly practical. A massive amount of practical microeconomic information can actually be gleaned just by looking at a single company's financial statements.
Oh, really? Just the financial statement?
Yeah. Because those abstract theorems about labor costs and production efficiency, they translate directly into the hard data on a balance sheet or an income statement. Profit margins, operating expenses, revenue. That is the microeconomic theory living in the real world.
Oh, wow. Okay, that bridges the gap perfectly.
Mm-hmm.
But of course, I mean, no company exists in a vacuum.
Right.
Millions of these individual micro decisions, like a company hiring 50 new engineers or, raising the price of a product, they eventually aggregate.
They snowball. Yeah.
They snowball into massive national trends. And that forces us to change our lens to the top-down approach. We have to look at macroeconomics.
Right. We are zooming out from the tree to the entire forest now. Macroeconomics is the study of economy-wide phenomena. We aren't looking at one company's profit margin anymore. We're looking at gross domestic product, or GDP.
Big scuff.
Exactly, inflation rates. And how GDP is impacted by things like national unemployment and national income. It looks at entire industries and asks massive questions.
What kind of questions?
Like, what should the inflation rate be, or what actually stimulates economic growth on a national level?
But to answer those questions, the text uses some really heavy jargon. It says macro focuses on aggregates and econometric correlations, and it looks at how changes in net exports impact a nation's capital account. Can we demystify that?
Yeah, let's break that down. An aggregate is just a huge sum, like taking the spending of every single person in the country and rolling it into one massive number.
Yeah, so consumer spending as a whole.
Right. And an econometric correlation is just taking two of those massive numbers, like the national interest rate and total consumer spending, and seeing how they affect each other.
Got it. And the capital account.
That's essentially tracking the massive flow of investment money crossing borders. Because macro focuses on these big statistical relationships, it is the primary tool that governments use to formulate fiscal and monetary policy.
Which brings us to a fascinating contradiction in the text about John Maynard Keynes.
Oh, yes, the founder.
Right, the text credits Keynes as the undisputed founder of macroeconomics for his use of these monetary aggregates. But then, almost immediately, it says economists constantly dispute his theories.
Oh, they argue about it endlessly.
Right. It even says his own followers, the Keynesians, disagree on how to interpret his work.
Mm-hmm.
If he is the undisputed founder, why is his stuff so heavily disputed?
What's fascinating here is that macroeconomics deals with such massive top-down variables that interpretation is just highly complex and totally subjective.
Because you can't put an economy in a test tube.
Exactly. You can't run a perfect scientific experiment. You are dealing with human psychology at scale. So measuring a modern economy is less like solving a math equation and more like trying to predict the weather. That's why it's a constant subject of debate.
Here's where it gets really interesting, though, especially for you, the listener. We've established the two lenses, micro and macro. But how do these theories actually affect your wallet and your investment portfolio?
Right, the practical application.
The text explains that microeconomics actually affects stock prices in two different ways, directly and indirectly.
Yeah, let's define the direct effect first, because it's purely mechanical. The direct effect is just basic supply and demand for the stock itself.
Like the actual piece of paper.
Exactly. If there are more buyers demanding a specific stock than there are sellers, the price goes up. It doesn't even matter what the company does in that exact second.
Okay, and the indirect effect.
That's where you look at the demand for the company's underlying products. If a company makes a wildly popular phone, robust product demand suggests a strong earnings trajectory.
Which eventually means a higher stock price.
Yes. Conversely, if demand is sluggish and have tons of excess inventory just sitting there, earnings suffer and the stock slumps.
That makes total sense. Which brings us to Warren Buffett.
The ultimate value investor.
Yeah, the text brings up this fascinating perspective from Buffett that kind of blew my mind. He explicitly ignores macroeconomics.
Completely ignores it.
In 54 years of working with Charlie Munger, Buffett said he couldn't think of a single time they made a stock decision based on a macro forecast. He actually called macroeconomic literature the funny papers.
It's an incredible level of discipline, honestly.
It sounds like Buffett is basically saying, don't try to predict the weather, just focus on buying a really sturdy, underpriced house.
That is a perfect way to put it.
Right. He just searches nation after nation, asking only which stock is priced lowest compared to its actual worth. He doesn't care if it's raining or sunny in the broader economy.
Because he believes if the house is built well enough, if the microeconomics are flawless, it will weather any storm eventually.
But, and I have to play devil's advocate here, if Buffett ignores macro, should we just throw out the macro textbook?
It's tempting, but no. The text provides a really crucial counter perspective here. While micro impacts individual investments, macro factors possess the raw power to devastate entire portfolios.
The weather can sometimes destroy the house.
Exactly. If we connect this to the bigger picture, we can just look at the historical case studies in the text. Look at the Great Recession of 2008 and 2009.
Right, the housing bubble.
Yeah. You could have owned shares in a perfectly run, microeconomically flawless company in 2008, but when the U.S. housing bubble burst and financial institutions heavy in subprime mortgages nearly collapsed.
It didn't matter how good your company was.
It didn't matter at all. The macro shockwave dragged almost everything down.
And that brings us perfectly back to the paradox we opened with today. The spring 2020 pandemic crash.
Yes, the ultimate example of macro overriding micro.
Because in 2020, governments and central banks unleashed torrents of liquidity. They used fiscal and monetary stimulus to just flood the zone and stave off a recession.
And that's what created the paradox. That macro intervention, that massive flood of money, ironically pushed major equity markets to record highs through late 2020 and 2021.
Even though the businesses themselves were failing.
Exactly. The macro environment completely overwhelmed the micro reality.
Which is why the text brings up global macro strategy, right? It's an investment style that does the exact opposite of what Warren Buffett does.
Totally the opposite. Global macro traders abandon the balance sheet entirely. They trade strictly on massive national or global events.
Like interest rates or political developments.
Yeah, currency levels, international trade, they are trading the weather, not the houses.
So as a listener, you are faced with this incredible tension. You can be the best microeconomic swimmer in the world, analyzing every strait, perfecting your form. But if a macroeconomic tsunami hits, does your form even matter?
Well, that's the thing. Managing that tension is the whole game.
So what does this all mean? Let's synthesize this for a second. Microeconomics helps us understand the individual, the business, and the specific stock, right?
Right.
And macroeconomics helps us understand the government, national policy, and the massive systemic tides. But the listener's portfolio performance ultimately hinges on both.
It absolutely does. True economic literacy isn't about choosing one side over the other. It's not about being exclusively a Buffett or exclusively a macro trader.
It's about context.
Yes.
Yeah.
It's about knowing which lens to look through at which time.
Which leaves us with one final, lingering question based on everything we've talked about today. We know that Warren Buffett ignored macroeconomic forecasts for 54 years to achieve historic success. He literally called it the funny papers.
He did.
Yet we also know that macro events like the 2008 crash or the 2020 pandemic stimulus can single-handedly dictate market highs and lows, totally steamrolling individual business performance.
They absolutely can.
So think about this. The next time you see a major economic crisis unfolding on the news, how are you going to react? Will you spend your time scrutinizing the balance sheets of your favorite companies, trusting the sturdy house? Or will you be watching the central banks to see how much liquidity they are about to unleash? Choosing the right lens in that moment might just be the most important financial decision you ever make.